Hey guys, good morning and welcome to the Camp Financial 6/24/16 update, or as I like to call it, the Brexit update. So when I made my video yesterday, obviously, I'd already seen the overnight results that European markets were down, Japanese markets were down, knowing full well that the US market was going to follow in lockstep. Any piece of uncertainty scares the stock market, so a lot of investors will get out, and the large corporations, they feed that, right? So a lot of the investing banks and that sort of thing, they see the pain and they jump out quickly, and usually a lot of their clients follow suit, especially like I talked about yesterday. If you are, if you're a longer term, or if you're a short term investor, so if you need the money because you're going to retire in 5 years, 3 years, any kind of uncertainty like this scares you and you panic and you got to get out of the market. If you're, if what you have invested is long-term investing, these types of, resets shouldn't scare you. They happen often enough that you should be prepared. So with all that said, let me take a look at the S&P 500. And so the system that I pull this up on, I use finviz.com and go to their screener, take a look at what happened in the market yesterday. If you take a look, out of the bottom 20 stocks, they were between negative 9.5% and negative 13.7%, and all but 5 of them were in the financial industry, which makes sense. Like I said, obviously these financial companies, a lot of their business is based on being able to either get credit spreads, get yield, etc. Most of most of the ones in the bottom 20, even more so, are either banks or asset managers or investment brokers and that sort of thing. There are a few life insurers as well down there in the bottom. So, but the bottom 5 are Invesco, Investment Management, Charles Schwab, and E-Trade. Obviously, all companies that rely on investors in order to generate returns for themselves. For them to make money, they need investors investing their money with them, through them, in order for them to make their commissions. So those were the 3. Then also in the bottom 5, you got Lincoln Financial, life insurer, and the Delphi Automotive Group out of the United Kingdom, which obviously also makes sense, being as how the United Kingdom was the one that kind of started the whole panic. Now let's take a look at the best performing in the S&P 500 yesterday. So again, take a look at the top 20. There are 2 financials in there. They're both realty investment trusts. So people looking for yield, getting concerned, jumping out of maybe a more speculative plays and trying to get into something that's more stable, which continues on throughout the top 20. As the rest of the ones in the top 20 that performed well, you have 10 utility companies. You have 4 consumer goods companies, which are Hershey, obviously, pretty recession-proof business, chocolate, Reynolds America, cigarettes, also very recession-proof, the Altria Group, also in the cigarette industry, Hormel Foods, consumer goods, packaged meat products. So all things that people are going to buy anyways. And then other ones, and another one here in the 20 is Kroger. Obviously, the grocery store. Again, people are still going to go shop at Kroger regardless whether the market got smashed or not. But the number one out of the S&P 500 was Newmont Mining Corp, the gold company. Again, I think we've already talked about them this week. Obviously, Newmont is a gold producer. Whenever there's uncertainty in the market, uncertainty with anything really, but especially with possibly foreign exchange, the dollar, the British pound, the euro, the gold stocks are going to perform well. Gold performs well when everything else feels like it's going out of control. So that was the S&P 500. Now let's take a look here at the Dow 30. Not a single stock in the Dow 30 had a positive day yesterday. The 5 that did perform the best, I guess, that didn't go down as much as everybody else: Walmart, Verizon, United Health, McDonald's, and Home Depot. Again, a flea for yield. Verizon pays a really good yield. McDonald's has a good yield. Walmart. All 5 of those companies pay a nice dividend and have a very stable company. Almost all of them are worldwide, so they do have impact when something goes awry overseas, but compared to some of the other ones, they're not as reliant on overseas purchases. For example, so the 5 worst performers in the Dow yesterday: Goldman Sachs, JP Morgan, Caterpillar, IBM, and Boeing. Caterpillar, Boeing, for sure, makes sense, right? I mean, we don't need to talk about the 2 banks. We've already talked about them with the S&P 500, and that makes sense. Caterpillar and Boeing, IBM, all 3 of them, especially Caterpillar and Boeing, have a heavy reliance on emerging markets. They definitely still sell to the domestic market here in the United States, but they have a strong push. That's where they're going to get their growth, is in that international market, the emerging markets. So it makes sense that they would have been the hardest hit yesterday of those stocks in the Dow Jones. Again, like I said before, I said yesterday, if you don't panic and you think about your long-term implications here, this is maybe a good buying opportunity. Now, my guess is stocks are going to continue to go down for a little while. You're probably going to see a little bump back over the next couple of days when people kind of get a little more level-headed, but this may be the beginning of a more longer-term downtrend into a bear market. That doesn't mean panic and sell everything you have. It means have an idea of where you're willing to sell, what kind of price you want to sell a stock at. If it comes down, if it goes against you, and be prepared to sell it. And then know at what price you're willing to get back in to either that stock or another stock if you found, another stock you're interested in. So say, for example, you're interested in buying Disney at $90 a share, or Apple at $90 a share. Well, right now, Apple traded all the way back down to $93.40, and Disney's trading at $95.72. So if you feel like that's a good value at $90 and it fits your portfolio, it fits your investment objectives, you're probably going to get the opportunity to get back into that stock at a nice solid price. So before I sign off today, I do want to talk, I guess I'm just going to go over, I have 3 different investing portfolios. It's all in one portfolio, but I use 3 systems to select my stocks for my retirement accounts and for my accounts. One, I think I've talked about all 3 of them before, but so one is a quantitative, a fundamental, and a technical. It uses all 3 aspects of when I'm assessing stocks. So quantitative, what I'm trying to do is I'm trying to find an industry that's performing well. And then fundamental, obviously I want to find a company within that industry that has strong fundamentals and the potential for growth. And then technicals, I'm looking for a company that's probably above its 50-day moving average, that's got a nice uptrend. Maybe it's just started, maybe it's even if it's a month or 2 in, it's okay. I may miss the first 5% of a move, and then I may miss the and then it may hit the top, and I may miss some on the way back down before I sell it. But for example, so that portfolio yesterday, S&P 500 was down 3.59%. That portfolio was down 2.34%. So not bad. And up until yesterday, so I have my year portfolio on this. This portfolio was up 10.35% this year versus the S&P that was up 3.39%. Obviously now the S&P is just under flat. This portfolio for me is a little over 7%, 7.5% roughly, that it's up this year. So, you can beat the market as long as you know what you're looking for, I guess is what I want to say partially. And 2 is don't be concerned about the single day, pops. It's more about the longer term trend. So now my second portfolio is strictly based on technicals. I know I've talked about that, where I'm looking for the price to be above a short-term technical level and the medium term to be ahead of the long-term technical level. And then I buy in. I have an automatic set trailing stop loss that if the stock goes up to a certain level, then it comes back, I get out at that price. I don't think about it, no questions. I just do it because I've tested the system and I know that it works. So that system dropped 2.56% yesterday versus the S&P 500's 3.59. Now I'll go to my newest system that I've been using, or that I just recently started using, and it is strictly fundamental based. So I'm looking to buy companies that are trading at a good discount to either their price to earnings multiple, their earnings are stronger, or they have a long-term growth projections, or something. But I don't look at the technicals at all on this system. All I look at is to find a company that's in a certain market industry, usually one that's kind of beat up, and I'm trying to find one that's at a good value so that when the market turns, it's got the ability to take off and make me 30, 40, 50% possibly, and possibly more. But just knowing that I have a certain idea of where I would want to sell the stock at and be prepared to get out when it got up to that level. But also keeping an eye on what's going on with the company, because we may find out, I may find out with the next earnings that their earnings are not as strong as they were projecting with with their last quarterly, and it may be that the stock's just not going to recover to that level. And then with that knowledge, knowing that, hey, it's time to cut bait. So like I said, this system, it's only been in place for just 2 months is when I started it. I started 2 months ago, so it has 4 stocks in it. So it really has not a, it's not tested, it's not diversified, it's very focused on certain markets. So one of the stocks in that is Unum Healthcare, and Unum obviously got destroyed yesterday in the market meltdown, and so this system is down was down 4.64% yesterday versus the market's 3.59. Overall against the market, it's pretty much even. Since April 20th, it's down a little bit more than the S&P 500. The S&P 500 is down about 3%. This system would be down about 3.5% actually. It's down about 3.5%. So, but yeah, so that gives you a little idea. Don't panic. Understand your investments and know that there may be more pain coming, but just understand how you're going to navigate the system. Navigate the pain. Just because you're feeling some pain, it may not be time to sell, or it may be time to sell. It may be time that you're just not comfortable anymore, and it's time to get out. So that's it, guys. If you have any questions, feel free, leave them here at the bottom of the YouTube video. You can find me on Facebook, Chris Mielek, @CMielik, on Twitter, or my email address will be in the bottom of the YouTube video as well, and that's Chris M @campfinancial.net. Like I said, hit me with any questions. I love helping people out. I can at least give you my thoughts on what a stock's going to do, or maybe an ETF or something like that. So, all right, guys, take care.